Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on the Nasdaq stock market. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Mark Marex, product development specialist with Nasdaq Index Research, joins me this afternoon to discuss Nasdaq-100 performance in what's been a week of volatile trading, particularly in the tech sector. And Mark, with the exception of valuation, it doesn't appear as if anything fundamentally has changed. So let's take a look at the charts for some more insight. The first one you are watching is relative performance.
Yeah, sure. Great to be back, Jill. And I'm getting a bit of a feeling of deja vu this week because I think it was in first week of June where we had a 5% drop in the Nasdaq-100 on a Thursday. And then I came on a Friday to talk about how, if you look at relative strength of the index, it was, in record territory back then in early June. It had that quick 5% down day. And then the next day on Friday, it had a slight recovery. And of course, we know what's happened the rest of the summer. It just continued to go up and up. So I thought I would update, this chart for starters. This is 14-day relative strength, showing you that really, not just above 70, which is typically considered pretty frothy, but actually breached 80 earlier this week when the index was flirting with 12,500. That's something that people have been talking a lot about recently, that the run-up has gotten a little bit ahead of itself in terms of fundamentals, and that some sort of corrective mechanism would actually be healthy for the market overall, and especially, within tech. So color me not surprised by the fact that we're seeing a bit of a cooling off period this week.
Yeah, I would agree with you there. Let's also move on to the 20-day moving average. Anything concerning there?
Yeah, potentially a little bit, right? So that first red circle, that's the early June event, the 5% drop I was talking about. Back then, we bounced right off of that level. 20-day moving average is usually kind of highlighted as good technical support in the short term. And you can see that we actually bounced off of that a few more times later in the summer after a couple, multi-day drops skirting that level. Today, unless we close at around 11,500, I think we'll close below the 20-day moving average, considering we've been down anywhere from 1% to 4% today. So that is suggesting that, over the next couple weeks, maybe this will be a more volatile period that won't necessarily recover and just resume that upward trajectory like earlier this summer. That's a, kind of 50-50 proposition, but that's the point of this chart.
All right, Mark, let's move along to the put-call ratio for the benefit of the audience. Explain to them what that is, why traders use it, and what you're seeing here.
Yeah, sure. So this is, 10 years of history. This is what the Chicago Board of Options Exchange, where most of the options trading activity in the U.S. takes place. They put together this ratio of really for the S&P 500, right? All the put call activity. So kind of a broader indicator of the overall market than just the Nasdaq-100. Point of this chart is to show that, not just in tech, but overall in the market, we were at, levels that you've seen a handful of times in the last 10 years. And if you go back 20 years, there are actually only 22 total days since September 2001 where we had a ratio below 0.4, and we were at 0.38 about a week ago. So really, really extremely bullish options activity. Some people have been talking about that's being skewed by a couple big players in the market, like SoftBank maybe, or some of the banks. But in any case, that's another indicator, that things had really gotten to be overly bullish in terms of positioning, and we can see that ratio has shot all the way back up to close to 0.6 this week.
All right, and let's wrap up here with the Nasdaq-100 versus S&P 500 ratio.
Yeah, sure. So again, earlier this summer when we talked about it, we were approaching record territory. We officially set a new record this week in terms of, you know, the price of the ratio of the two indexes with respect to each other. We hit 0.29 on September 1st. That's the lowest I've seen going back to, you know, end of 1999. So encapsulating the sort of peak of the dot-com bubble in early 2000. So really, you know, across all four of these metrics in terms of relative strength of the index, in terms of technical support, in terms of, you know, overall options positioning for the broader market, and in terms of the index getting a little ahead of itself versus the S&P, again, I think we shouldn't be too surprised that this is going on. Nothing really fundamentally, like you said, has changed with the story, but we were just on a torrid pace. I think someone on our team the other day pointed out, on a year-to-date basis, this was the best year-to-date gain in like 23 years as of end of August. So pretty extraordinary stuff.
Yeah, certainly a healthy sign to see some pullback here, Mark. Great to have you on Trade Talks. Thanks for joining us.
Always a pleasure. Thank you, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.